pick my punishment? If I'm arrogant enough to say I can beat the market in a bear market, I should be arrogant enough to accept whatever comes with being wrong. No excuses. If this blows up, I'll own it publicly and take the hit with a sense of humor. This is a $100,000 live account, real money. I started this 100K account to prove one thing, that a properly engineered hedge portfolio, even with heavy leverage, can make money in both bull and bear markets. It can harvest volatility and tame the leverage beast into a source of profit. If I fail, you decide the punishment. I will publish the account on a regular basis. Stay tuned to see me beat the market or enjoy the fun spectacle if I fail. And for the record, I really don't want to sit in a rolling rally car again. Yes, that's one of the punishments. I've done that enough times for 3 lifetimes. Welcome to the leveraged hedge. I bought my first stock option back in 1986. I managed and drove for a professional racing team. I was the trader at a top U.S. hedge fund, and I've structured deals worth hundreds of millions. But to be honest, trading is still hard for me, and it should be hard for you too, because the real challenge isn't knowledge or prediction, it's human nature, fear, temptation, patience, discipline. On this channel, you won't find stock tips. You won't find fundamental or technical analysis. What you will find is how to create alpha by quantitatively structuring your trades and portfolios, by using leverage and hedges with discipline. My goal is simple, to grow wealth with you slowly. Welcome to the leveraged hedge, the manifesto for asymmetric investing. Let me start with something important. I do not know what the market will do tomorrow. I don't know what it will do next week, and neither does anyone else. Anyone who tells you they do is either lying or delusional. Markets are complex, adaptive systems. They react not just to data, but to expectations, positioning, fear, leverage, and reflexivity. Short-term outcomes are dominated by noise. So if your strategy depends on predicting the next move, eventually it will break. Not because you're unintelligent, but because the problem itself is unsolvable. That's not pessimism, that's realism. Here's what I do believe with high conviction. The U.S. economy over time will be larger than it is today. The top 500 U.S. companies collectively will earn more money in the future than they do now. Innovation will continue. Productivity will compound. Capital will flow toward returns. This doesn't mean the market won't crash. It will, repeatedly. But over long horizons, the direction of travel is clear. And if that premise is true, if long-term equity growth is the dominant force, then the rational response is uncomfortable. You should invest as much as you reasonably can, which brings us to leverage. Leverage has a terrible reputation, and honestly, most of the time it deserves it. Used carelessly, leverage doesn't just increase returns, it amplifies volatility, accelerates mistakes, and destroys discipline. Most investors don't blow up because they were wrong on direction. They blow up because they were too leveraged at the wrong time. So when people say leverage is dangerous, I actually agree with them. But there's a nuance almost nobody talks about. Leverage itself isn't dangerous. Unhedged leverage is dangerous. The real problem isn't leverage. The real problem is asymmetry. Limited upside paired with catastrophic downside. That's a losing game. If you want to use leverage responsibly, 2 conditions have to be met. First, leverage must be applied systematically, not emotionally. Second, and this is non-negotiable, downside risk must be explicitly engineered, not ignored. That's it. That's the entire framework. This channel exists for one reason, to explore how leverage and hedging can coexist, deliberately, quantitatively, and with discipline. Not through stock picking, not through macro predictions, not through chart patterns, but through portfolio construction. We'll focus on structures where upside participation is preserved, drawdowns are constrained, and emotional decision-making is minimized. Because once you remove prediction and replace it with structure, the game fundamentally changes. I was trained as a fundamental analyst. I can read balance sheets, I can value businesses, and yet I do not pick stocks here. Why? Because stock selection introduces unnecessary uncertainty. Because concentration magnifies behavioral risk, and because even the best businesses eventually disappoint. Okay, I will be honest, I chose this route because I am lazy and because picking stock is hard. Did you know that 4% of the stocks actually provides all the gains in the stock market ever? That means you have 1 out of 25 chances of picking a winning stock. That is almost as bad as going to the casino and put your money on a single number bet. Instead of trying to predict which company will outperform, we are going to engineer something far more robust, a portfolio structure. No narratives, no forecasts, no hero trades, just math, mostly high school math. This is not a stock picking channel. This is not a trading signal channel. You are not here to copy trades. You are here to observe process and learn the philosophy behind asymmetric portfolio construction. In future episodes, I will explain the portfolio structure step by step, show you the logic behind each component, and report the live portfolio performance weekly in full transparency. You will see what works, what doesn't, and how discipline, not prediction, drives results. If you want to join the process, you can. But the real value is understanding why the structure behaves the way it does. At the start of 2026, I opened a brand new live account and funded it with $100,000 of real capital. The objectives are explicit: outperform the S&P 500 by 3% annualized over a full market cycle. In a future episode, I will show you why this is actually a very high hurdle. Limit maximum drawdown to under 15%. This is more important than returns. Why? Because when you reduce drawdown, you compound faster. Lower drawdowns lead to higher long-term returns, even with lower nominal upside. But here's the part people underestimate. When you know you're not facing massive drawdowns, you actually sleep at night. And peace of mind matters more than almost anything in investing. I still remember a story my old boss's girlfriend told me. She woke up in the middle of the night and saw him sitting up in bed, gripping the bedside lamp, screaming into it. "I told you to sell, just sell." It's a funny image. But there's nothing funny about building a portfolio that keeps you awake at 3 a.m. So what's the magic sauce in my portfolio? Honestly, nothing exotic. The idea is almost embarrassingly simple. I load up on as much of the most volatile ETF I can find, and then I buy an almost unreasonable amount of insurance against crashes. Now, the obvious objection is insurance is expensive. You're just bleeding money on hedges. That's the part I want to challenge. Yes, insurance is expensive if you buy it lazily, but if you select it with discipline and engineer it with intent, it doesn't have to be a drag. In fact, with highly volatile ETFs, insurance can become a source of return, not just protection. At least, that's the hypothesis. And I could be wrong, which is where you come in. You're here to keep me honest. So this is my punishment test. If the S&P 500 enters a bear market, defined precisely as a 20% decline from peak, this portfolio must outperform the market by 20 percentage points. In plain terms, if the S&P is down 20%, this portfolio must be down less than 4%. I can explain the math behind that requirement if you want, but the point is simple. Downside protection must work when it matters. If it doesn't, then the framework has failed. If my system fails that bear market test, you choose the consequence. 1. Run naked on a public nude beach. 2. I take an ice bath for 1 full minute. 3. I will film myself rolling a rally car. 4. Donate $10,000 to the American Red Cross. 5. Distribute $10,000 to 10 selected viewers of this channel. Leave your choice in the comments. Your choice will be my command. This is not about spectacle. It is about accountability. The real reason this channel exists isn't leverage, and it isn't even performance. It's discipline. By putting this portfolio in public view, I deliberately remove my own ability to trade emotionally. Once something is visible, it becomes harder to rationalize bad decisions, harder to improvise, harder to chase the next shiny idea. And that's where you come in. You're not just watching this portfolio, you are part of the system. You're my commitment device. The downside of having too much market knowledge is that you always see opportunity everywhere. Silver is up 6% today. AI stocks are up 5%. Something is always moving. But investing rarely fails at the entry. It fails at the exit. Getting into a position is easy. You, or at least I, always get out at the wrong time. By constantly jumping from one great idea to the next, you end up doing one thing very well, leaving most of the gains on the table. This channel is how I stop myself from doing that. By clearly stating what the strategy is, what I'm allowed to do, and more importantly, what I'm not allowed to do, I create pressure. The good kind, the kind that enforces trading rules instead of improvisation. With that discipline in place, I genuinely believe this portfolio can be exceptional, best in class even, not because it's clever, but because it's structured, asymmetric, and repeatable. My goal here is to build wealth slowly, asymmetrically, and with discipline with you. You get to observe the process in real time, and if you choose, participate alongside it. No predictions, no hype, just structure. Welcome to the leveraged hedge, leveraged returns you can actually hold, and quiet nights of sleep.
Thank you for watching this episode. Your presence is the commitment device that I rely on to stay disciplined. If you found value in this, share it with someone who might benefit. We will build wealth together, slowly and with discipline.